So my name is Fraser Bowen. I'm a director in the Pan-European Capital Markets team at JLL London, based in London, but we cover really from Oslo to Oman and North Africa, so it's a pretty big patch. As a business, we're trading 170, 180 million euros every day of the week, so kind of 40% market share across Europe. So there's not much that goes on that we're not in some shape or form involved in. And really, I just wanted to give you a feeling today about all key sectors, so offices, which is my main focus, some retail, and then logistics. I'm conscious with the audience, there's a lot of focus on the residential game and on the multifamily, but maybe we can pick that up separately. Just given the audience, I think these statistics are pretty incredible, and I think if you look and if you were to speak with most of the German, French, probably UK fund managers, they would be shocked by these. I think that there's so much noise around the Asian capital and around Chinese money in Europe at the moment. It's deafening. But what these stats show that, in terms of the audience we have here in the room, you are pretty much the most aggressive and successful buyers of real estate in Europe at this current time, and that is, it's the Lone Stars, it's North Stars buying SEB's portfolio. We have Oxford Properties coming into Paris. They're obviously in London. We will see them go into Germany next. I've got absolutely no doubt. Blackstones of the world. We always have this slight issue: do we call them US? Do we call them global? So there's we can fudge the numbers, so to speak, as required. We continue to get asked about what is driving the market, and it's the easiest answer is this weight of capital point, but it cannot be underestimated. Let me just click this through. This just shows you. So it's the discussion or the panel we've just had just now, UK, France, Germany, that's the grey, and you can see a massive increase in volumes. But I think what we're going to see continuing as we go through the cycle, Spain, Italy, CEE really starting to pick up. The number of investors focusing on Europe at the moment cannot be underestimated. We've just had bids last week on a 300 million euro-dollar asset in Berlin. It's a great location, but there's 20% vacancy, and it's got its work cut out. We had 20 bids from around the planet. We did a portfolio recently in Barcelona, Spain, Barcelona, 95 NDAs signed. And so you can start to get a feeling of the amount of parties who are out there interested. So there's a lot of disappointed people, more disappointed than happy, and I think that's what continues to push the pricing. Let's just jump on in terms of sectors. Nice picture of Paris there. Looking at prime office yields. Really, compression across all yields, with the exception, for obvious reasons, of Moscow. But what's been really interesting with Moscow, all of a sudden this is where we're seeing the Chinese guys turn up. So we've got CIC, so the sovereign entity, hawking around, trying to take down some big opportunities now in Moscow. Similarly, Adia, I remember sitting with the guys in Abu Dhabi 2 years ago asking about Moscow, and they said they would have to be in a cardboard box 10 foot under the ground before they went to Moscow. But that has clearly changed now, and that is a political play as much as anything. So it's not quite over for that market yet, but you can see that the theme here really, those areas in black showing really the basis point changes, and it's been so fast across particularly the Iberian markets, the yield shift, and to an extent in Ireland also. This just gives you peak to trough, so the best of the best, middle of 2007, I suppose, till when we think we started to see things come back out, and that would have been early mid 2010. You can see there's really only few markets that are actually beyond the previous peak, and that is Berlin, it's Copenhagen, it's Hamburg. But those are markets with really, really small bandwidth. They're really steady from the perspective of yields. And I think to Martin's point earlier, just looking at some of those, if you want to call them second-tier markets of Germany, so Cologne, Düsseldorf, Stuttgarts of the world, I think we can definitely see some yield compression coming into these markets, driven predominantly by the domestic money, by the German money. But with that, there's a real liquidity play, which I think should never be underestimated for when the tide inevitably goes out. CEE, I think, is a big play. We haven't discussed it yet, but we'll pick it up in the next session. We're seeing increasingly German capital coming to that market. We've got some Taiwanese guys coming through, and then there's increasingly a lot of US money looking at that market also. Particularly so Budapest, Bucharest, Prague. Just to give a feeling, I mean, this is going back to 1990. I was in shorts, but it gives you a feeling of where the capital value growth has come from over the time. And in this last cycle, it's really all been about yield shift. So the big question is, how much dislocation is there between the occupier market and the investment market? We would suggest it's probably not as bad as people suggest. The recovery is taking place in a relatively tight market, so supply in the main is limited. There is very limited excessive speculative demand, unlike the last cycle. So we would suggest that rental growth is underpinning the current valuations and pricing going forward. Just to look and get a feeling for sentiment, this is a survey not done by us, so it's we've got no axe to grind on this. This is done by, from memory, I think it was Oxford Economics, just to get a feeling as to how people in the street are feeling. And you can see, Italy, Spain, Portugal, I mean, they're feeling pretty good about life. CEE, Benelux, also. To Lauren's point earlier, even the French are looking pretty happy, and I think the United Kingdom there. This was done in April, so this is pre-election. I think we're definitely as a conservative, I'm giving everything away here, but we're feeling in a generally happier place. Greece, hasn't been mentioned today. Massive headwinds. I don't know if anybody really has the answer in this room as to what's going to happen there, but it's something for discussion generally. So, office rents. This is the key. This is where we're going to see performance over the next let's say 24, 36 months. And you just need to look at Madrid, Barcelona, 30-40% below the last peak. I mean, it's absolutely incredible. So if you can get into assets that have been effectively rebased, to an extent, that's why people are happy to pay 4 or 5% on the yield, is because you're going to see significant rental growth come through. And then again, so we're looking at the engine room cities, Dusseldorf, Stuttgart, etc. Slightly beyond the last peak, but equally, given they are the engine room cities of Germany, we expect to see things continue unabated in those markets. This is just looking at office take-up. Again, the theme: Spain, Italy, increasingly looking like pretty strong markets. The one that I would probably want to pick out here is the UK, and particularly if you start to think about London City. If you were to split London into the various villages that it definitely is, so Mayfair, St James we're seeing £150, £155 a square foot now, which is absolute record rents. If you split it into the different villages, the City of London, so the square mile, is probably 13th most expensive place to occupy space in London, Greater London. So we really see rental growth coming through in that market. There's a massive amount of demand, probably 3.5 times, if you like, oversubscribed than what we're looking like getting in terms of supply. So looking overall, I mentioned earlier, really limited speculative demand. Warsaw is a bit of an outlier, and we can maybe pick that up in the next session. But if you just look, again, labour the point, Barcelona, and we're seeing, and we expect, if our numbers are correct, basically one office completion this year, and it's owner occupied. So there is nothing out there that's, for example, in Madrid, we just recently took new office space, and you think of all the people on the planet who should be able to get nice new top quality office space. It would be us, given it's our day job. We have had to split into 2 separate offices, one across so we've got 100 guys on one side of the street, 100 guys on the other. So that just gives you a feeling as to what's going on in that world. And this just again is following on in terms of the grade A shortage. Forecasts, offices generally, Madrid out there, London City I've talked about, Barcelona for obvious reasons, and then we start going into the probably more regional cities. Rome for some reason is down there as a -1. Maybe we can ask the Italian guys later what's going on there. But the Dublins, Milans, really positive, strong rental growth coming through. Jumped onto retail. This excludes high street shops. So this is shopping centres, big box retail, factory outlets, etc. UK, Germany, France absolutely dominate this market, probably around 3/4 of the volume. And then if we add on Italy and Spain, that basically takes you up to the vast majority of the retail transactions across Europe. UK, far and away the biggest market. We've seen really quick and significant capital growth, and that's really been driven by yields. We're starting to see the rents pick up in the core markets, but to the point we've Scunthorpe and Skegness has come through a few times in discussions, slightly spurious little towns, and I think that's where there's again big headwinds for the occupier market there. The French figure is probably slightly skewed. There was 4 very large transactions last year, so Beaugrenelle was 700 million. There was the Carmilla formation, so the Carrefour deal, which was 2.5 billion. Ireland stands out there as they've had a good year, right? So if you get paid in percentage terms, it's a pretty good place to be. 2,200% increase. But that's really, that accounts for like 1 billion in terms of volume, so it's not huge. And that was a Heinz deal for Asian HSBC money. So again, just to touch upon the volumes, 37 billion. So we're back to, if you want to call it pre-crisis or peak volumes. That's where the retail world is currently trading. Again, peak to trough yields, just to give you a feeling as where we were, where we are. Spain is again a big theme in the retail world. So we've seen yields move probably about 100 bips in the last 12 months. But just to my point earlier, in the same way as the office world, if you can get into retail opportunities that have had their rents rebased, that's where we're going to see the real good performance, strong performance going forward. Just to give you a feeling of, and this is stuff you probably already know, but where are the occupiers trying to go? It's the key core markets. It's obviously London, it's Paris, it's Berlin, it's Milan, it's Munich. So that's the places with all the global appeal, and then after those top tier markets, that you can slowly but surely see growth into the regional market. There is one thing which is there's significant churn in the retail occupier market at the moment. So we are seeing probably for every 2 stores that open across Europe, 1 will close. So this is retailers right sizing. It might just be moving from one corner of the street to the next, but there's a lot of churn going on. Interestingly, though, again, just to look at the Iberia and Dublin, massive occupier demand, looking from tenants trying to get into those growth markets going forward. Finally, for me, in terms of the logistics market, this is far from my specialist subject, but my colleagues were keen to give us, or give the room here, a feeling as to how it compares the European logistics market to the US market. So if you look at grade A modern logistics stock in comparison to the US, there is an argument that Europe is undersupplied fundamentally. If you look at it on the basis of stock to population. So the US 1.8 square meters per person versus Europe at 0.5 square meters per person. I'm still trying to work out what that all means in terms of growth numbers going forward, but that's the facts they were keen to get on the table. Key markets remain, again, UK, France and Germany. Sweden definitely a big play in terms of logistics, but it's the UK market that makes up probably 40% of the volumes across Europe, but that's probably 3 times more than its biggest competitor, which is Germany. So it's a huge market, the UK logistics market. Southern periphery, so and CEE, again, massive increase in volumes, so it's 300, 400% trading volumes increase in those markets. Our good old peak to trough yields, again, on the logistics world. So it's Germany really that's driving the hardest yield compression. So Frankfurt, Hamburg, Düsseldorf. Similarly in Paris, we're seeing probably around 6%. These yields are always assuming probably 10 years of income, but there is a big argument that if you have, let's say, 20, 25 year deals, so for example, John Lewis recently in the UK, you could probably take about 50 to 75 basis points off those prime yields, so really pretty aggressive pricing. In terms of occupier demand, really it's the third-party logistics operators that are driving things. What's interesting is that whilst the UK is the biggest investment market, it's the German occupier market that is the busiest. But probably 50% of the stock in Germany is owner-occupied, so there's a lot less in terms of opportunities for the occupiers to step into. E-commerce clearly, a big driver. But we think probably makes up around 5% of the demand currently. But then if you add on where e-commerce is then sublet or passed on to the third-party logistics operators, it's probably making up around 15% of demand. Just to give you a general overall feeling of the vacancy rates, granted here we're looking at a lot of different countries, so it's there's no particular theme to pick up, but overall we're looking at a vacancy rate of around 7%, but that compares to around 9-10 at the peak of the last bull run. Development activity, just to round up, we're seeing around 8.5 million square meters under construction at Q1, which it's the highest in the last 5 years. Although we do see, if you take away Russia, which is, they are building stuff like it's going out of fashion over there. If you take out Russia, it's a manageable supply coming through in comparison to back in 2007. So that was a very fast run through, high level, all sectors, all countries. I hope it's been of use.